laying down the groundwork for our discussion with Jal Irani, who's Senior Vice President, Institutional Equities Research Analyst at Edelweiss Securities. Jal, it's great to have you on the show. First, just, give us your own sense of, with all the business verticals doing what they are, Reliance has hit a fresh record high. What's driving the move?
So, I think Reliance, as you know, has spent about $55 billion in the last few years. And now you're seeing a confluence of all these projects which have essentially just gone on stream. The last of the $5.5 billion is also about to go on stream. This compares to its earlier producing assets of about $31 billion. Now, given such a large capital work in progress earlier, its ROE was suppressed to about 11%. If you look at even FY18, the ROE has already started improving. Similarly, ROCE is about 200 bips. So I think it's so that's number one. There are a lot of these projects which are going on stream, and the market's beginning to anticipate a strong earnings growth. Secondly, even if you look at Reliance with actually, even without the benefit of these projects, it is one of the few stocks which has been showing earnings growth consistently. So even the last year, its earnings grew by 18-19%, and similarly the year prior to that, versus the Nifty index, or as a benchmark, showing virtually zero growth. And the third thing is that a lot of these projects were considered as high-risk projects. So you will recall at one stage, the market was essentially saying that LTE technology will not work at all, they don't have the towers, so on and so forth. Now that is very well established, and hence what is also happening is that there is a risk mitigation which is driving up valuations. So this is resulting in two things. This is resulting in earnings will accelerate, earnings which is already healthy, but actually there's a valuation re-rating which is poised to take place. So both things are actually driving stock price very strongly.
Jal, hi, morning. I know we are completely running out of time, and you have very little time, I understand. So let's quickly take it across to OMCs. What really is the call here? What do you believe is going to be the outlook on the marketing margins from here on? And especially given that these stocks are down 20 to 25% from the recent highs in the last 6 months, should this dip really be bought? Is the worst behind us when it comes to OMCs?
I must apologize, but I think on OMCs, the appropriate disclosures need to be made in advance, and you all hadn't mentioned that we'd be discussing this. But there's only one thing that I'd highlight, if you'd like, on this. The OMCs are counter-cyclical to oil prices, and essentially, so in other words, if oil is expected to go up, the stocks go down, and vice versa. Now, the situation in oil is essentially that there is very little spare capacity globally. The OPEC countries barely have about 2.5% of spare capacity globally, and shale, which is ramping up in the US, is constrained by infrastructural bottlenecks, so they can produce at a cheap rate, but they can't evacuate the crude. And hence, essentially, what one is seeing at the moment is that global utilization rates in oil are effectively in the high 90s. And that leaves very little scope for disruptions in oil, which tend to be many. And therefore, in my opinion, the risk to oil is on the upside, and hence you can then figure out what is potentially going to happen to the OMCs.
No, fair enough. But just outlining your thesis for looking at Reliance's price move, and I'll come back to that point. how do you look at the sum of parts playing in right now, whether it's, what they're doing on the refining side, the potential of KG-D6, or what's the kind of value addition that the market is ascribing because of Geo and the rollout plans there? How do you summarize which will be the area which will be more defining for Reliance in the coming years?
I think one needs to recognize the fact that while Geo is a new sort of growth area which has come through recently, Reliance's bread and butter business will always remain refining and petrochemicals. Essentially, we feel that at least 60% of the value of Reliance is its bread and butter refining and petrochemical businesses, and in those areas it is expanding as well. So for example, it's spending another $4 billion in upstream, $20 billion of capex of what has come on stream is actually in the refining petrochemical areas, and that actually is Reliance's cash cow. Now, cash cows tend to be valued higher. In fact, if you look at the last AGM speech of Mr. Mukesh Ambani, he himself says that the energy businesses will contribute as much as 1 lakh crores to the EBITDA. So, needless to say that Geo is a significant component going forward. Retail is also a significant component, but more than 60% of the value will continue coming out of its refining and petrochemical businesses. In fact, in the near term, a bulk of its earnings will continue coming out of that. I mean, essentially 90% or so of its earnings will be from its refining and petrochemical businesses.
I really appreciate you taking the time out, and thanks so much for joining in today with your take on Reliance and just an overview on what's happening with the OMCs. But what's happening with KRBL? Why is that stock headed in for such a deep dive in trade? The last time I checked, it was down almost 18%. Let's quickly bring on board Anup Kumar Gupta, the joint MD at KRBL. Anup, hi, good morning. Please explain to us